Okay, so let's start this round from South Africa, where the anti-graft watchdog has reopened an investigation into whether Barclays Africa Group benefited from an apartheid-era bailout. A preliminary report by the country's public protector has found that the apartheid government breached the constitution by supplying Bancorp, which was acquired by Barclays Africa unit ABSA in 1992, with a series of bailouts from 1985 through to 1995. Barclays Africa could have to repay 2.25 billion rand if the findings by public protector Busisiwe Mqebane is upheld. A previous investigation in 2000 by a central bank appointed panel found that the loans were made to stabilize the banking system, and ABSA shareholders did not derive any undue benefit, recommending no further action be taken. Meantime, here in West Africa, the International Monetary Fund plans to visit Ghana to hear the new government's plans for implementing the country's $918 million aid deal. President Nana Akufo-Addo was sworn in on Saturday, pledging to cut taxes, spend on development, and boost annual growth to double digits as he seeks to return Ghana to its place as one of Africa's most dynamic economies. He also inherits a country following the fund program that aims to reduce inflation, public debt, and budget deficit, and put Ghana, which produces gold, oil, and cocoa, on a stable footing to facilitate long-term growth. Meantime, the OPEC Secretary General Mohamed Bakindo says on Thursday that crude-producing countries will decide next May whether to extend their collective outputs cuts beyond the first half of the year. The committee of OPEC and non-OPEC producers responsible for monitoring compliance with the November decision will hold their first meeting on January the 21st and 22nd in Vienna. That will be next week. So let's get more on this from Dolapo, who is the head of energy research at EcoBank Group. Dolapo is joining us via Skype in downtown Lagos. Dolapo, good afternoon to you.
Good afternoon, Bolton.
Yes, we always have this conversation on Twitter anyway, so we all know where we are as far as things are. I'm just getting interested in some of the stories you tweet about India crude purchases from Iran, and how Saudi Arabia is cutting February deliveries to Asia, exempting a few countries, but China's crude import is still significant. So hoping everyone there that this will keep oil prices above $50 a barrel.
Yeah, I'm quite positive of that. If you look at the two major oil importers, India and China, their imports actually grew significantly last year, and what was driving it was a significant amount of domestic consumption. A lot of cars were bought in China last year, India as well too, a lot of cars. Middle class folks can afford to pick more cars and put them on the road, and so that's driving fuel consumption and also imports. And again, because look at their industries as well, also to trying to churn out more products and all that. So that's driving demand on that side. And then you still have all the storage plays that they are still trying to make sure that they have more oil in storage as well too. So we expect that to continue to drive oil prices this year alongside the OPEC cuts.
But again, look at the statement in the last 24 hours yesterday from Bakindo, the OPEC Secretary General, that there could be further cuts in the month of May. What do you think Bakindo is hitting at here?
Okay, because I think the game has changed for OPEC now. It's no longer a market share war. I think it's clear that they won that war. But the game now is revenue. OPEC is cutting, because now the question is there has to be a significant amount or shift in oil prices to compensate for the cuts that they are making. And to some extent, they still feel they haven't achieved that yet. Don't forget, we actually saw $58 oil on the back of the expected cuts, even before the cuts were actually made. But now that the cuts are actually being made, I mean, we've seen cuts already being made by Saudi Arabia, by Iraq, by Kuwait, and even Angola as well. And even Russia has also come out to say they were making their cuts. They've made a cut of 100,000. But still, yet prices are still fluctuating between 52 and 55, between 53 and 55, 56. So it still hasn't quite hit the mark of what they are trying to achieve. So I believe that's why they're thinking maybe we still need to make more cuts.
Yes, so by this time next week, we'll be talking about the OPEC Implementation Committee meeting in Vienna. What's your outlook on this meeting?
I think you'll find it's been very successful so far. Most of the countries that agreed to make cuts are complying. I mean, even Angola as well, making some significant cuts. Russia has made a cut of about 100,000. Saudi Arabia is making. Kuwait, first of all, set us in motion. Some of the non-OPEC countries as well, too, are also complying. Bahrain, Oman, they're also making their cuts. So I think they will find that they are being successful. But, I mean, there are still many months ahead, and they still have to ensure that the cuts are fully implemented.
With the level of cutback that you've seen so far, 1 or 2, 3 countries within the Middle East where some of these the producers are you encouraged by what you've seen so far, or you are expecting more rapid cuts early enough in the 6 months timetable to allow confidence to boost and prices to also move on? Some folks are looking at 60 here. Do you think that would drive it?
Yeah, for the Middle Eastern guys, it's actually, in fact, different strokes. For the Gulf countries like Saudi Arabia and Kuwait, the cuts are fairly easier to make because there's a national oil company that controls pretty much all of production. But when you start looking at countries in the Middle East like Iran, like Iraq particularly, Iraq has like 3 or 4 different divisions. You have the Kurdish region where you have the Kurds, who are almost a different country of their own. It's going to be difficult to implement a cut there. You have the IOC-controlled fields in the southern part of the country as well, where you have contracts. It's going to be a bit difficult, but maybe slightly easier than the Kurdish region. And then there's some parts of Iran where they're even trying to get, they contacted Sonangol recently to come and help them develop it. So there will be government-controlled areas where they can make those cuts. So the cuts will actually progress slowly in the Middle East. But I'm encouraged, and to some extent, I think we're getting there. But the flip side of this will always be the fact that, of course, as for every cut we make it easier for shale to come back. We make it easier for the high-cost oil countries, non-OPEC countries, to push more oil into the market. So it's still going to be a balancing game overall.
No, it's a game, really, isn't it? Sometimes it could really get very unnerving how this will go round and round and round. Thank you so much. Let's leave it there for today. Dolapo, it's good to see you. Enjoy your weekend.
Thanks for having me.
And see you at the other side. Thank you for being part of the program today. Finally, JP Morgan Chase says the Mozambique is poised to miss payment on a $60 million coupon next week, but a former International Monetary Fund official who is advising bondholders insists the government has the money. The country's $27 million worth of bonds sank to a record after JP Morgan analysts said the government's rhetoric implies it's highly unlikely to make the payment on January the 18th. Mired in a financial crisis after commodity revenue plummeted and the IMF cut aid, Mozambique said in October it would seek to restructure the Eurobond as well as $1.4 billion of government-guaranteed loans to 2 state-owned companies. That's about all for today. We thank you for watching, everyone. I'll see you again. Have a great day.